Let's clear something up because this confuses a lot of people. When the Federal Reserve announces a rate cut, that does not drive mortgage rates. The Fed rate is the rate at which banks borrow money from each other overnight. A mortgage rate is something a consumer borrows for 30 years, and that's a very different set of terms. What the Fed says and does affects the financial markets, and that affects the securities that affects mortgage rates. Now, don't be afraid of the chart. Here's everything you need to know. Green means the market got better that day. Red means it got worse. Higher points in the chart are good for mortgage rates. Lower points are bad. Let's look at a couple of key dates. Things were running along pretty nicely a few months ago, and then we got to the first of the big Fed announcements in this quarter on September 17th, and you saw that mortgage securities took a beating on that day. And then they continued to drop down for the next several days and didn't get back up to where they were before the Fed announcement until near the end of October. Then the October announcement came. And right here on this big red line is when they announced the next quarter point rate cut. And they fell again. This is the December 10th date. This was the last rate cut, and pricing improved significantly. So what this chart shows you is that the federal funds rate does not drive mortgage rates. It drives the market somewhat, and that can affect things. But understanding how the market works is how we make your mortgage financing plans work that way. Rates don't drop because the Fed rate cuts. They drop when they expect the cut. The bottom line, waiting on the Fed isn't a strategy, but understanding the market is, and that is how we help you win.